Hello, this is Books of the Stock Market. How's everyone doing? As for me, I just bought a new pair of maroon Ultra Boost 4.0s, and my old Ultra Boosts that I wear like every day were getting a bit worn out, so I thought I might as well buy a pair while my size was still in stock. I wear a size 10 shoe, and they usually all get sold out in a month after they restock, and I don't run in them because they're so soft, but they're the most comfortable shoes on the market in my opinion. Anyways, let's get on to today's topic. So last week, we finished talking about trend lines. Starting from this week, we will be talking about major reversal patterns. The first reversal pattern that we'll be going over is the head and shoulders pattern, which will be talked about towards the end of the video, so keep watching till the end. Before we talk about head and shoulders, we must talk about price patterns. Price patterns are unique patterns that can be classified into different categories that allow traders to predict price action. Patterns can be categorized into two types, a reversal pattern that signals a reverse in the trend, and a continuation pattern, where the current trend does not change. Furthermore, if you listen carefully throughout this video, you'll see how volume plays a key role in price patterns. For many, if not all reversal patterns, these 6 guidelines are almost always followed. First, a prior trend needs to exist. Second, one of the first signals to a reversal is the breaking of an important trend line. Third, larger the pattern, the greater the move. Fourth, market tops are shorter in duration and more volatile than bottoms. Fifth, volume is more important when the trend reverses to an uptrend. So let's talk about the first guideline, which is pretty straightforward. Basically, it means that for a reversal to happen, there needs to be something to reverse. You can't reverse a trendless price action. The second guideline was that one of the first signals to a reversal is the breaking of an important trend line. However, it is important to remember that breaking a trend line does not necessarily mean that there is a trend reversal, but that there just might be a change in the trend. For instance, the change in the trend could be an uptrend or a downtrend, changing into a consolidation type pattern. So it is always important to remember that there is always this third option of horizontal movement when dealing with trend changes. The third rule was that the larger the pattern, the greater the move. So how do you define a large pattern? Well, there are 2 dimensions that play into the role of determining the size of a pattern. The first dimension is the height of the pattern. The height of the pattern is how much the stock moved dollar-wise within the trend. Furthermore, the greater the height of the price pattern, the greater the move. The other dimension is the width of the pattern. So this is how long the trend was held, so greater the width of the price pattern, the greater the move. Let's look at this example. Here we see SPY, which is an ETF that tracks the S&P 500. When COVID hit at around March, we saw a huge price drop. So how do we figure out the height and the width of this downtrend? This is fairly simple to do due to the tools available these days. In this case, there is this ruler tool, and we can see how much price has moved vertically and how long this trend has lasted. According to this tool, the price dropped around $120.20. This trend has continued for 23 trading days and lasted for 33 days, which includes weekends. The fourth guideline states that market tops are shorter in duration and more volatile than bottoms. This is where the saying that timing the market tops is nearly impossible, and you'll be probably losing money if you try to time tops due to its short duration and volatile movements. Furthermore, this guideline can also be turned into the saying where bottoms take longer to build and are less volatile. So it is important to remember that before you start buying after a 30% retraction, it may be wise to be a bit patient. The final guideline is very important to all reversal patterns, and you'll see this guideline be relevant when discussing the head and shoulders pattern, which will be covered after we go over this final guideline. First, volume should increase in the direction of the trend. This idea has been discussed extensively in the video that covered the Dow theory. I'll link that video in the comment section and at the end of this video, so watch it if you want to know more about this concept. Second, when completing each pattern, there should be an increase in volume. I'll show you an example of this when we discuss the head and shoulders pattern. Finally, especially at the ends of bottom, there should be an increase in volume to confirm the price breakout. This can also be seen in the head and shoulders pattern. Now, with the introduction of patterns out of the way, we can talk about the head and shoulders pattern. Let's first start off by naming the components of the head and shoulders pattern. The image here shows Bitcoin, which is a hot commodity these days. The first peak is called the left shoulder. The second peak is called the head, and this is when the price is at the top. The third peak is called the right shoulder. In between the left shoulder and the head, we have the first dip. In between the head and the right shoulder, we have the second dip. The final component is called the neckline. The neckline is formed by the first and second dip lows, and this needs to be broken for the pattern to be valid. As shown, I drew the line such that the wicks of the two dips touch the line. Price usually retests the neckline once a breakaway happens, but sometimes it just breaks away as seen in Bitcoin. Now, let's talk about volume and how it plays an important role into the head and shoulders pattern. The left shoulder should have heavy volume, as without any knowledge of the future, it just seems like an ordinary uptrend. The first dip should have less volume because once again, without any knowledge of the future, it just seems that price may be dipping to fix the oversold condition and correct different technical indicators. The head usually has less volume than the left shoulder, and this is when the stock makes new highs. The second dip usually moves below the peak of the left shoulder, which now becomes a horizontal resistance level. It then reaches near the first dip. The right shoulder should have noticeably lighter volume than the left shoulder, and it fails to make the level of the head, and therefore a higher peak was not formed, signaling a reversal. Remember, in an uptrend, there needs to be consecutive higher highs. Finally, the breaking of the neckline occurs, and when this happens, volume should increase to confirm the price action. This example with Bitcoin should help us visualize what I just said. Here, we see volume seem to peak, giving us our first shoulder. I then drew this blue line to help demonstrate the relative volume levels. After that, we see the head form, and if you notice, this volume is much higher than the volume of the left shoulder, which does not match the typical characteristics of a head and shoulder. This is okay, as with all technical analysis, theory and real-life situations may differ. However, after this, everything is by the book. For instance, here we see volume never picking up to the levels of the left shoulder, as we see the green bars that signal buying is always lower than the horizontal blue line. Once we get to our right shoulder, we see the right shoulder form, but you can see the volume never reaches the level of the left shoulder. When the neckline breaks at the red circle, we see a huge increase in volume, which confirms the move downward. The opposite of head and shoulders is the inverse head and shoulders. Here, we see the same left shoulder, the head, and the right shoulder. There are a few differences between the inverse head and shoulders and the head and shoulders. The first difference is that volume is more important, and you should be less flexible when volume doesn't match these following characteristics. First, volume at the head is lighter than the left shoulder. Second, volume leaving the head should increase and be more than the volume at the left shoulder. Third, the second dip should have lower volume. The second difference is that price usually returns to the neckline with light volume. For instance, let's return to this graph. Here, we see the price return to the neckline, and we see that it first held it as support, but it broke through it, causing this inverse head and shoulders to be invalid. For this pattern to be valid, price should have held this area as support and then bounced off it to move upward. Once price breaks, where does price go to? One way to measure the distance is by getting the vertical distance from the head to the neckline and subtracting this difference from where the neckline broke. The alternative way is to get the vertical distance from the head and the second dip and doubling this difference. Then subtract this distance from where the neckline broke. Both of these two techniques are minimum price movements. The maximum price movement is erasing the whole previous trend. So if the price climbed from $50 to $250, price will retract back to $50 after the head and shoulders has occurred. However, with all the theoretical guidelines, you must be adaptive. For instance, if there is a local resistance and support near your minimum price projection, you should adjust it to the support and resistance price level. This can be applied to the 50% and 66% retracements and even major support and resistance lines. Well, that is it for this long video. I hope everyone learned as much as I did reading a book, as that is the whole point of this channel. In this video, we learned about the head and shoulders pattern. The next video will be talking about another major reversal pattern called the triple tops or bottoms. So if you don't want to miss out on these topics, please subscribe to the channel. If you enjoyed this video and felt like you learned something new, like this video as it really supports the channel. If you have any questions, leave a comment below and I'll try my best to answer all the questions. Well, this is Books of the Stock Market, and I'll see you guys next Wednesday at 3 p.m. Central Time. Thanks.